Aloha, I'm Stan Cox, Principal Broker and Strategist with SC Finance Strategies and Insurance Consultants, and author of the books on the tax-free cash growth warehouse strategy. In this video, I'm going to give you the information you need to know before buying life insurance. First, I think you should know that I actually am qualified to educate on this topic. I've been a licensed life insurance advisor since 2013, which means that I've been required to study and pass exams to certify that I do know this stuff. In fact, just last week, I completed a 10-hour course all about life insurance products. You should also know that I am an independent broker and assigned by at least a dozen life insurance companies. That means I'm not obligated to sell or promote any one type of product or company. I want to equip you with the knowledge you actually need to make the best decision for yourself regarding what type and how much life insurance you should buy. So let's get on with it. You need to know what kinds of life insurance there are and what the benefits and drawbacks are to each. You also need to know going in exactly what your goals are for the life insurance and whether the type of product you're looking at will satisfy those goals. And yes, there are different products that are better suited for different goals. Okay, the three main kinds of insurance are term insurance, which is the cheapest and most common, universal insurance, probably the most widely promoted these days, and whole life insurance. Term insurance is the cheapest because it has only one purpose. That is to pay a monetary benefit to the beneficiaries of the insured. But as the name implies, the policy is good only for a specified term or period of time. Usually, the terms are for 7, 10, 20, and some cases 30 years. At the end of that term period, the policy ends and there is no benefit to the insured or their beneficiaries. Every year, as the insured grows, or ages, I should say, the cost of the insurance increases according to the mortality rate. That is, the chances that the insured will die. So there are term policies that the premium paid increases every year. There are those that the premiums increase every 5 years or every 10 years. And there are level premium term policies where the increasing costs are averaged out over the term of the policy and the premium is set at the average at the beginning of the policy and remains the level amount throughout the term of the policy. Term policies are best suited for ensuring that credit obligations such as mortgages and other loans will be paid off in the event of the insured's death. Real quick now, there are actuaries, people who compile all the research and determine the odds of people dying. They produce actuarial tables, of which include the mortality table or rates. Actuarial tables play a big part in the underwriting or approval process for life insurance. As a result, about 98% of all term insurance policies never pay out. And that's because if the actuary tables indicate that you will likely die within 30 years, you will not be approved for a 30-year term policy. Same goes for all the term policies, whether it's 20 or 10 years or less. So the biggest benefit or plus for term policies is that compared with the other types of policies, they are the cheapest. If you were comparing starting a policy at the same age and for the same benefit amount. For example, if you're 35 years old in good health and non-tobacco user, and you compare $250,000 policies, if the term policy is $500 per year, a universal policy would be about $800 per year. And the whole life policy would be about $1,000 per year, all other things being equal. We'll look at that again toward the end of this discussion and see how value is affected over time. So stick around because that's really important and interesting. Universal policies have a few variations. There are guaranteed universal, indexed universal, and variable versions. The guaranteed universal has a guaranteed death benefit and a minimum guaranteed premium. Ideally, the death benefit will not diminish or go away before the death of the insured, and the premium will not increase. But, and this is a big but, that's under ideal conditions. You see, universal policies are built upon a term policy. They have certain options included in their design that allows them to accumulate cash value. And that's certainly a positive. But as already stated, mortality rates increase every year, so the cost of insurance increases every year. There are also various management fees charged to the account. As a result, the cash value grows very slowly. And then later in the life of the policy, the costs and fees begin to eat up any cash value that has accumulated. Because of that, many universal policies lapse or terminate without any benefits being paid. If the owner of the policy overfunds the policy by paying additional premiums, the policy can be kept in force. If not, there's a very real risk that the policy will lapse. The other two variations, indexed and variable, provide for an investment to be tied with the policy, which can greatly improve the chances the policy will not lapse and that the cash value may grow significantly more robustly. The critical key words here are chance and may. It's not guaranteed. And with the indexed version, it is possible that no cash value will be added. And with the variable version, there's a very real possibility that the policy will lose money. And in those cases, the owner needs to pay additional funds just to keep the policy going. So universal policies, indexed and variable, may be best suited for those willing to take a gamble in order to possibly increase the cash value gains of the policy. That leaves us with whole life. Now, as the name implies, whole life insurance is for your whole life. That's in more ways than one. The death benefit is guaranteed, as is the premium. So while the premium is greater for the same person and the same amount of as a term or universal policy at the beginning of the policy will not terminate, and the death benefit will not decrease, and the premium will not increase. With whole life insurance, cash value accumulates at a guaranteed compounding rate and may grow better than the guaranteed rate. With some whole life policies called participating policies, the death benefit increases over time, even though the premium does not increase. Those participating policies also receive dividends in addition to the guaranteed interest rate, which is why and how they may grow faster and greater than the guaranteed rate. So while the premium for whole life is higher than for a term or universal policy at the beginning, all other things being the same, the benefit is that even if you get sick or incapacitated, the policy doesn't lapse and doesn't increase in premium. Now, let's go back to the premium comparison again. If the term premium for a $250,000 policy is $500 per year, and the whole life premium is $1,000, what happens after 30 years? Well, if you were 35 at the start of the policy, now you're 65 years old. With the term policy, you now have no insurance because the term is up, and you have no cash value returned to you. So even if you're still in great health to buy a new term policy, and if you would qualify for a new 20-year policy for $250,000, your premium is going to be somewhere around $2,400 a year. And the whole life premium is still at just $1,000 per year. Not only that, the whole life policy, the death benefit has likely grown to closer to $300,000, and your cash value in the policy has grown to around $40,000. You don't have to buy a new policy. Just keep paying the $1,000 a year. With both the universal and whole life policies, when there's cash value accumulated in the account, and by the way, that cash value grows tax-free or tax deferred for the legal eagles, you can take policy loans against the cash value, and there is no tax on those loans and no penalties. Bottom line here is, term is good for mortgage and credit insurance. So the amount of insurance should be equal to the total of the debts. Universal can be good for cash value growth if you're willing to gamble on it. And whole life has the greatest value overall, has guaranteed growth with potential for greater growth, and is safe and reliable. For those reasons and the potential design options, we love participating whole life for the infinite banking tax-free cash growth warehouse strategy. You can learn all about that by watching our free webinar. Just click on the link in the description box below here. Now, as for how much insurance you should buy, if your goal is to provide financial security for your loved ones, the general guideline is 10 times your annual income. So if you earn $50,000 a year, the total amount of insurance you should purchase, either universal or whole life, should be at least $500,000. If you earn $100,000 a year, your policy should be $1 million policy, 10 times your annual. Now, if your goal is to use the policy as a tax-free cash growth warehouse for infinite banking, you should figure out a policy that has a monthly premium equal to 6 times your age. So if you're 40 years old, you should start with a policy that has a premium of $240 a month. That's 6 times 40. And the policy needs to be designed properly by an expert in the strategy and design of policies for it. You really should take advantage of the free webinar and learn about this king of finance strategies, the tax-free cash growth warehouse infinite banking strategy. Go ahead, click the link in the description box below and watch the webinar now. And if you like what you've learned here in this video, please subscribe to this channel. Also, go ahead and post your comments and questions here. We're here to help, and we look forward to helping you. For now, aloha and mahalo for watching.